Quick reminder, this is educational analysis of historical data, not financial advice. The most popular momentum indicator in trading won just under 42% of its trades on real Bitcoin, and still barely broke even. That's the MACD. Most people run it without understanding it. By the end, you'll know exactly what it is, its three parts, its three signals, and its real weaknesses. And we answer the big one. Does the famous strategy built on it actually make money? We coded it and tested every signal. The results surprised us. No hype, just the tool and the truth. MACD stands for Moving Average Convergence Divergence, a long name for a simple idea. Think of it as a momentum meter. It takes two moving averages of price, measures the gap between them, and shows whether that gap is widening or shrinking. That's the whole engine. When momentum builds, the two averages pull apart. When momentum fades, they drift back together. Convergence and divergence, the lines coming together and moving apart, is literally what the name describes. So the indicator isn't measuring price directly, it's measuring the speed and strength behind price. A widening gap says the move has force behind it. A narrowing gap says that force is draining away, even if price is still moving. Keep that mental picture, two averages and the shifting distance between them, because every signal the MACD gives you is just a different way of reading that one relationship. Simple idea, useful lens. Adding it to your chart takes seconds. On any charting platform, TradingView, your broker, an exchange, open the indicators list, type MACD into the search box, and select it. It won't sit on top of your candles. Instead, it appears in its own panel directly beneath the price chart with its own horizontal scale. Leave the settings exactly as they load. The defaults are 12, 26, and 9. The numbers nearly everyone uses, and the numbers every guide and every backtest, including ours, is built around. There's no need to tweak them when you're learning. Changing them just makes your readings harder to compare with everyone else's. So, open indicators, search MACD, add, keep the defaults. That's the entire setup. Now look at that panel beneath price, because it contains three distinct parts, and understanding what each one is doing is the difference between reading the indicator and just watching lines wiggle. Three parts live in that panel. First, the MACD line, the faster line, built from the 12 and 26 period averages. It's the quickest to react. Second, the signal line, a smoothed 9-period version of the MACD line, its slower shadow, always lagging a step behind. Third, the histogram, the bars rising and falling around the center. Those bars measure the gap between the two lines. When the bars flip from red to green and start growing, momentum is turning up. When they shrink and flip back to red, momentum is fading. The histogram is really just a visual of the distance between the two lines, and running straight through the middle of all of it is the zero line, the level where the two moving averages are equal, with nothing between them. Two lines, a set of bars, and a center line. Master those four elements and the three signals become obvious. Let's read them one at a time. Signal 1, the crossover, the single most used MACD read. When the faster MACD line crosses up through the slower signal line, the histogram flips green and momentum is shifting upward. When the MACD line crosses back down through the signal line, the histogram flips red and momentum is shifting down. That's it. Here on Real Bitcoin, watch the two lines converge, touch, and separate. The bars flip color, and the move follows shortly after. It's clean and intuitive, which is exactly why so many traders lean on it. But notice the word follows. The cross confirms a shift that has already begun. It doesn't call it in advance. Hold that thought because it becomes important later. For now, the takeaway is simple. MACD line over signal line means momentum turning up. MACD line under signal line means momentum turning down, and the histogram color makes it visible at a glance. 1 signal down, 2 to go. Signal 2, the zero line, the simplest filter there is. Remember, 0 is the level where the two moving averages are equal. When the MACD line sits above 0, short-term momentum is broadly leaning bullish. When it sits below 0, momentum is broadly leaning bearish. That's the whole read. The common rule of thumb is to take crossover signals in the direction the MACD already leans. Bullish crosses when you're above 0, bearish crosses when you're below. The logic is straightforward. It keeps you moving with the prevailing momentum rather than betting against it. Interestingly, the popular strategy we test later flips one part of this, using crosses below 0 in an uptrend to catch early turns, and we'll see how that choice performs. For now, hold the principle. The 0 line tells you which side momentum favors, and aligning your signals with it filters out a share of the weaker ones. It's a coarse filter, but a useful one. Before the third signal, one foundation, swing structure, because the term only makes sense once you see it. Markets don't climb in a straight line. In a healthy uptrend, price steps upward. It makes a peak, pulls back to a dip, then pushes to a higher peak, and pulls back to a higher dip. Each peak taller than the one before, each dip shallower than the last. Those are higher highs and higher lows, the fingerprint of an uptrend. A downtrend is the exact mirror image. Each peak fails to reach the previous one, and each dip drops below the one before. Lower highs and lower lows. That's it. 4 terms, 2 patterns. Higher highs and higher lows going up, lower highs and lower lows going down. Keep those 4 firmly in mind, because the third and most sophisticated MACD signal is nothing more than price, and the MACD disagreeing about them. When they tell different stories, that disagreement has a name. Signal 3, divergence, the subtlest MACD read and the one traders prize most. Picture an uptrend. Price pushes to a fresh higher high, looking strong on the surface, but look down at the MACD panel. Instead of matching that strength, the MACD prints a lower high, a weaker peak than its previous one. Price is climbing, yet the momentum underneath it is quietly fading. That disagreement, price making a higher high while the MACD makes a lower high, is bearish divergence. It's a warning that the move may be running out of fuel, sometimes right before a reversal. The bullish version is the mirror. Price grinds to a lower low while the MACD makes a higher low, hinting downside momentum is drying up. Divergence is powerful because it can appear before a crossover does. But treat it as a caution flag, not a trigger. Momentum can fade for a long time while price keeps drifting. It signals weakening force, not a guaranteed turn. On settings, keep it simple. The standard values are 12, 26, and 9, the defaults on nearly every platform and worth leaving alone, especially while you learn. People endlessly tinker with these numbers hunting for an edge, but faster settings just produce more signals and more noise, and slower ones lag even further behind. The defaults exist because they're a reasonable middle ground that everyone shares. More important than the numbers is the mindset. Read momentum, don't obey it blindly. A crossover that agrees with the trend and sits on the right side of the 0 line is worth far more than one firing against both. The MACD is at its best as one input among several, a way to gauge whether the force behind a move is building or fading. It is at its worst when treated as a standalone command to act. Same indicator, completely different results, depending on whether you use it as a lens or a lever. Read it, weigh it, then decide. Here's how a signal looks in practice, on one concrete trade. The MACD line crosses up through the signal line while both lines are still below zero, an early momentum turn. At the same moment, price is trading above its 200-period exponential moving average, the 200 EMA, are evidence the broader trend is up. Those two conditions agree, so this qualifies. You enter on the open of the next candle. You place your stop just below the 200 EMA, defining exactly what the idea costs if it's wrong. Then you set your target at 1.5 times that risk. Risk 1 unit to make 1.5. In this instance, price runs up and tags the target before hitting the stop. A clean winner, booked by rule, no emotion involved. That's precisely how you'd act on a signal in this system. Fixed entry, fixed stop, fixed target. One trade tells you nothing, though. The truth lives in the sample. Now the limits, the part most videos skip. The MACD is a lagging indicator. It's built entirely from moving averages of past prices, so by construction, it confirms a move after it's underway, never before. You are always reading a slightly old story. That's the first weakness. The second is worse in practice. In choppy sideways markets, the MACD whipsaws. The two lines cross back and forth, over and over, firing a false signal, then the opposite false signal, then another, each one tempting you into a trade that immediately reverses. Trending markets are where it shines. Ranging markets are where it quietly bleeds you through fees and small losses. This is why every experienced trader learns the same rule. Never use the MACD alone. Pair it with the trend, with support and resistance, with the actual behavior of price. It's a supporting instrument, not a soloist. Keep those two flaws, lag and whipsaw, in mind as we finally test it. So does it actually work? We coded the popular MACD strategy exactly as it's taught, a crossover below the zero line, filtered by the 200-period EMA to keep us aligned with the trend, targeting 1.5 to 1. Then we ran every signal on real Bitcoin. Across 84 trades on the 4-hour chart, it won about 41.7% of the time. Here's the catch. At a reward to risk of 1.5 to 1, break-even sits at 40%. So a 41.7% win rate lands right on the edge, just past break-even, compounding to roughly flat over the whole test. Now the number that hurts, simply holding Bitcoin over the same window, returned about 1,619%. That was a bull market stretch, and we state that openly. The lagging, whipsaw-prone strategy nearly ran in place while doing nothing ran far ahead. The indicator is a genuinely useful lens. The magic strategy built on it is not magic. So now you know the MACD honestly. What it is, a momentum meter reading the gap between two averages. It's 3 parts, the MACD line, the signal line, the histogram, around the zero line. It's 3 reads, crossover, zero line, divergence. It's 2 real weaknesses. It lags, and it whipsaws in chop. And how it actually tested, 84 trades, a 41.7% win rate against a 40% break-even, roughly flat, while holding returned about 1,619% in a bull market we named plainly. Use the MACD as a momentum lens alongside price, trend, and structure, never as a crystal ball, and never alone. That was the answer to the question we opened with, popular doesn't mean profitable. This has been educational analysis of historical data, not financial advice. Always do your own research. If you value honest breakdowns that let the numbers speak, subscribe, and we'll keep testing the tools everyone talks about.